Hi, this is week 12 of European financial markets, and I thought I'd do another current events that focuses a bit on the tension that we saw in sovereign debt markets last week. The graphic you see on your screen right now is the spread between Italian and German 10-year bonds, and as you can see, there was a moment of high drama somewhere toward the middle of the week. It's calmed down a little bit since then, but the spread remains higher at the end of the week than it was at the start of the week, which is obviously not a good sign. So why are the markets so worried about Italy, I guess is the first question that we have to answer. What can the European Central Bank do in response to this market concern? How likely is it that the ECB is going to do more than it already has? Because let's not forget, the ECB has done a big deal already. What can the Italian government do on its own? And what are the implications for next week's European Council summit? Because on the 23rd of April, the European Council will meet by video conference in order to make some important decisions that we've highlighted earlier, and I think we need to talk about again. I can only guess that when I do this recording next week, we'll be talking about the results of that summit. So hopefully we'll have something good to say. But for now, we can at least set expectations. Well, the bottom line is the markets have good reason to worry about Italy. They have good reason to worry about Italy because the debt level is high and increasing. It's over 130% of GDP right now. The IMF in its recent fiscal monitor anticipates that it's going to go up above 155% of GDP, partly because of the increase in expenditure, partly because of the decrease in gross domestic product. But whatever the reason, the number is increasing, and as it increases, it becomes more challenging to manage, which doesn't mean it's unmanageable. It just means it's more challenging. Having said that, the rollover requirements on the debt that they already have are significant. We'll see about 30 billion rolled over this month, a little bit less. I'll show you the numbers later on. Fortunately, the numbers are going to go down, and I'll show you that as well. And the growth prospects are low and decreasing, right? The longer Italy stays under this lockdown, the more GDP is likely to be affected, which could mean, of course, that the debt to GDP ratio that the IMF is estimating right now may be on the low side. Now, all of this is just background to the real cause for concern, which is that the governing coalition in Italy is divided, and so is the opposition. You'll have seen that when they had their vote in the European Parliament about a resolution to talk about what the European Council should decide next week, the votes were all over the map. The Five Star Movement was voting against its own government's proposals. The opposition parties were voting against things that they said they wanted and then voting for other things as well. And it's just complete chaos in terms of the way preferences were revealed in that parliamentary vote, which suggests that there's a lot of positioning taking place in the Italian political spectrum. And the reporting this morning is all about the extent to which that positioning could ultimately undermine the stability of the government. We're not expecting to see that, but it's something that we want to bear in mind. And if you're a market participant, that's an obvious cause for concern. So what can the ECB do to alleviate this concern? Well, in part, it's already doing a lot with the pandemic emergency purchase program and the other purchase programs that it has in place. You'll know about that because we've talked about that before. Indeed, it may be doing too much. Now, this is put in quotation marks because it's going to have to do whatever it has to do. But if you look at the burn rate on the pandemic emergency purchase program, it's very high. At the start of last week, which was 3 weeks into the program, the ECB had already spent over 50 billion euros. We don't know how much they've spent this week. We'll learn on Monday, which is the 20th of April. When that number comes out, it'll be an important number for us to look at. If it's north of 80 billion, because they're only reporting the cumulative spend. If it's north of 80 billion, then you have to just do the math in your head and ask yourself, well, how can they run this program all the way to the end of the year if they're burning it at 80 billion a month? And within that burn, we have to look at some real serious questions about how much flexibility the ECB is exercising in terms of the purchases that it's making. Now, the ECB is not being incredibly transparent in the structure of its purchases. That's actually okay. If you're really interested to find out, you can dig into the balance sheets of the corresponding institutions or into the ECB's own balance sheet and find out what the net change is on the assets of of different national origins in different issues. So it's not like they're hiding the information, they're just not making it readily available, and that's because they're determined to exercise flexibility in the purchases that they make. But the flexibility is benchmarked against the proportions that are set out in the capital key, which is the relative size of GDP weights. And we know that at some point they're going to want to bring the structure of their holdings back to that proportionality. What that some point is depends on who you talk to. Christine Lagarde had initially suggested, when she was talking about the 120 billion purchase program that was added on the 12th of March, she initially suggested that any disproportionality would be eliminated by the end of the calendar year. It's hard to see how they could do that within the pandemic emergency purchase program, just because the program is so large and the purchases must be very skewed in order to calm the markets the way they have. They must have been buying much more Italian debt than is warranted under the capital key, which means at some point in the future they're going to have to buy less. And how they do that is going to be a challenge that the people who manage the market side of the relationship of the ECB are going to have to address, right? We should also ask a question: if they're going to run out of money before the end of the calendar year, the ECB's governing council has made it clear that they're prepared to go even further. In other words, add more money into the pandemic emergency purchase program. But we have to wonder, given that they've made a decision to make a decision on that by setting the limit at 750 billion, whether they're going to be willing to expand the program further, particularly given the disproportionality of the purchases. So there's real big open questions on that. Why are there open questions? Well, the open questions don't really have to do with leadership. They have to do with divisions within the leadership. And here, I think the divisions within the leadership are best represented by this interview that Jens Weidmann gave to Bloomberg, where he made it absolutely clear that he believes that as soon as this pandemic crisis is passed, that government should return to fiscal consolidation. Now, if the ECB at that point is holding on to a massive amount of Italian sovereign debt, and it will be, then what interest do they have to keep adding to that volume of Italian sovereign debt? Wouldn't it be better to find some way to create incentives for Italy to do the fiscal homework that it needs to do? Or at least that's how the argument runs. In that context, it would probably make more sense, and again, I'm rehearsing an argument, this is not my personal opinion, it would probably make more sense to nudge the Italian government into accepting funds from the European Stability Mechanism for two reasons. First, that way the Italian government would qualify for assistance from the European Central Bank in the form of outright monetary transactions, which is the ECB's commitment to buy unlimited amounts of short residual maturity sovereign debt instruments in order to stabilize the markets. And the ECB could do that without explicitly adding on to the pandemic emergency program. And the second reason is that if they borrow from the ESM, then they're going to have to renew that money at some point. And so even though the initial money that they might get, this money that's been promised to be 2% of GDP, if the Italian government needs it to cover emergency medical expenses or medical costs associated with the coronavirus epidemic, when that money gets to be renewed, then the Italian government would go into a proper ESM program with all the conditionality attached. Now, again, this is an argument. This is not my opinion. But if this argument actually were borne out, that would create a very strong incentive for the governing council to say, wait, rather than expanding the program, let's use the instruments that are already in place. If the real problem is simply stabilizing Italian and by extension also Spanish sovereign debt markets. So that would be an argument for the ECB not to do more. Well, in that context, I think we should confront that data I keep alluding to. There's good news and there's bad news. The good news, and you'll see this on the left-hand side of your screen, is that the redemption calendar is relatively empty as we head into the summer. The pace of redemption slows down. Much of the redemption activity is taking place on the short end of the spectrum in the form of bills that are less than 12 months in maturity, so that's relatively easier to push into the market. The longer bonds, the BTPs, they will have been largely redeemed, and then there's a big gap in the calendar, at least until September. Of course, that's problematic, and this is where good news becomes bad, because September, which is normal in the way you structure these redemption calendars, that you increase the pace in the autumn, September may also be the time when we face a second wave of this coronavirus epidemic. And if that were to be the case, that would mean that Italy goes back into a high redemption pace at the same time that the Italian economy goes back into lockdown. That would be bad. Even more worrying, I think, for me, is that at the end of this calendar year, and this is where we're moving to the right-hand side of the screen, at the end of this calendar year, we enter into 2021, where the pace of redemptions in long-term sovereign debt instruments actually has to increase. And that's because the volume that they already had scheduled to be redeemed is even larger next year than it was this year. And if the Pandemic Emergency Purchase Program were to disappear at the same time that we have this larger volume of redemptions, that means that the Italian government is going to have to struggle a bit in order to make sure it rolls over that debt in a timely manner. So we may see at some point in the future that Italy will struggle to manage its sovereign debt burden at precisely the moment when the ECB is winding up its emergency purchase programs, if indeed it takes that decision. All of this is very conditional, but it's worth laying out because I think it helps to explain why the markets would be worried. So what can the Italian government do? Well, the Italian government is going to do is continue to add to its existing stock of debt. It's already announced stimulus packages that are going to add some weight into the direct spending, so not just guarantees. And with any luck, what it's going to be able to do is to issue some special bonds to Italian citizens. They've got an auction planned for mid to late May where they're going to sell directly to the citizenry. That's partly because there was a big set of bonds that matured in March that were sold to the same audience last time around, and there are a lot of Italian citizens that are looking to put their savings somewhere safe. That would help Italy in terms of being able to fund itself without having to rely explicitly on the markets, because this is another area of savings that they can tap. The Italian government can also rely increasingly, as it has been doing, on credit guarantees and tax deferrals. These are things that allow it to put stimulus into the economy without having to record that as an immediate debt or deficit. And so in that sense, it adds stimulus without adding to the burden of debt management, at least in the present. At some point in the future, that could transform into debt, and that would be something that has to be managed then. But deferring the problem now would probably be a good thing. And let's face it, it could also try to accelerate the loosening of the physical distancing requirements to restart the economy. That's a big push-button issue in Italian political debates right now, particularly between the League-controlled regions of the north and those regions of the south that tend to have more five-star presidents, regional presidents, or regional presidents who are not from the League. And the conversation about that has both a health dimension and an economic dimension, and accelerating the loosening up in economic terms may help to alleviate some of the burden or impact on the economy. I say may because if there are significant health consequences, then we end up back in the same place. So what are the implications? I think the implications looking ahead are that we're going to see growing pressure for some mutualization of debt, as we talked about in the context of the Corona bond debate. And there, Emmanuel Macron's recent interview with the Financial Times is a good illustration of the kind of pressure that can be brought to bear. I think there's also pressure that's taking place to reshape the multi-year financial framework, which is the 7-year budgeting program for the European Union, in order to strengthen the recovery of Europe's economy by front-loading significant expenditures, particularly those associated with investment, and we'll have to see whether that takes place. I know the Commission is pushing very hard to increase its borrowing capacity as well. And in doing so, I think it's going to be important for them to separate those two conversations, one about the multi-year financial framework and the other about the mutualization of debt. in order not to jam both up at the same time, because let's not forget the multi-year financial framework conversation has been difficult all on its own and even before the coronavirus crisis. So imagining that we could combine that with the mutualization conversation and get an easy result is a difficult thing to conceive. That said, it's going to be very hard to avoid a debate about how the recovery fund is going to be structured, and it's also very hard to understand how that debate is going to be resolved. There's a lot of interest at stake here. There's a lot that needs to be done, and clearly there's a lot of concern in the market that whatever is accomplished is either going to create political problems that can't be managed, or it's going to be inadequate to ensure the kind of debt sustainability that makes it attractive for them to remain exposed to countries like Italy, but I should add also Spain. So what should we do? Well, I think we need to keep an eye on how much money the ECB spent out of its pandemic emergency purchase program. We'll find that out on Monday. We also need to keep an eye on the political responses, particularly from Angela Merkel and Mark Rutte to Macron's interview and to other pressure for mutualization. No doubt that has already taken place. I just haven't seen it in the media yet. But I'll dig around to see what I can find. We should try to follow the positioning on the European Commission on the multi-annual financial framework talks, and particularly its powers to borrow. This is a really important issue because it could change fundamentally the weight of the Commission in the future of the European Union. So we'll keep an eye on that as well. And while we're focusing our attention on all those things, I think we should not lose sight of what's not going to happen. And I suspect we're going to see very little desire for fights to break out between East and West, particularly as the governments of Central and Eastern Europe explore new political arrangements that many in the West feel uncomfortable about. We're going to see very little desire to pick overt fights with them until we get this North-South conflict sorted out and everybody's happy with the way the European Union is going to move forward, at least on that dimension. And then they'll probably come back to look at the other side, the governance issues, and see whether that's really a cause for concern. Anyway, thanks a lot for your time. I hope you enjoyed watching, and I'll get ready to do the course videos now.